One of the most passive ways to invest your income is to invest in dividend stocks. But the biggest question people have is, how much money do I have to have invested in dividends to be able to retire forever? Well, today in this video, we are going to answer that question for you. Now, as we go through this video, the first thing I want to explain is some of the basics of dividend investing. And if you don't know what a dividend is, it's when you buy into a company and it shares a portion of the profits with you. And this typically happens every single quarter, but some dividend stocks will actually pay you out every month, depending on what it is. There's a lot of different dividend stocks out there, like REITs, for example, that will pay you a monthly rate. And there have been a number of different people who have retired off investing in dividends. But there are some things to consider if you want to become a dividend investor and you want to know how much you have available when it comes to dividend investing. Now, there's a bunch of different pros to dividend investing. Number one is it gives you regular income. You know when those dividends are going to be paid out, and you get this regular income, and so you want to replace your daily income with dividend income so you don't have to work anymore. Number two is the power of dividend reinvestment. Reinvesting your dividend creates a snowball effect, meaning every time that you start to invest in stocks, you can reinvest those dividends to buy more shares, and all of a sudden your snowball grows. And then they reinvest again to buy more shares, and that snowball grows even larger. And this creates a very powerful compounding machine, and over time, you can build a massive amount of wealth through dividend reinvestment. Number three is stability. There are a lot of companies out there, mainly the dividend aristocrats and dividend kings, who have paid out a dividend for a very long period of time. So if you select the proper dividend stocks, you know you have stability in place. There are companies out there that have been around for 100 years or so who paid out a dividend for decades and decades and decades. So this is something where you can expect a stable dividend, and if a company is underperforming and not paying out their dividend, you can move those funds to another company who is performing and paying out their dividend. Another pro is you can hedge against market fluctuations. Typically, the market's going to go up and the market's going to go down. But if you look at some of these dividend companies, they still will pay out their dividend even when the market is down. So you can hedge against these fluctuations, especially if you are interested in living off dividends. And then another pro is the tax advantages, because investing your money is going to reduce your taxable income. Investing your money is going to allow you to have a lower taxable income than your earned income would be. The thing with dividends, though, is there are two different ways that they are taxed. So you got to make sure that you understand which type of account to put your dividend stocks in, and you have to understand what type of dividend they are. There's something called qualified dividends and non-qualified dividends. So qualified dividends are subject to long-term capital gains tax rates, meaning that if you own this company for a year or longer, you're going to pay long-term capital gains when you sell that stock. Long-term capital gains depends on your income. This can be anywhere from 0%, 15%, or the max is 20%. So if you make a large amount of money, maybe you make $1 million per year, for example, then it would be in your best interest to invest that money because it lowers your taxable rate and your taxable income when you sell those shares to 20% instead of something like 30, 40, or even 50%, depending on what state you're in. Now, non-qualified dividends are the opposite, and these are taxed at your ordinary income tax rate at 37%. So when you have non-qualified dividends, one of the best things that you can do is put these in something like a Roth IRA, because a Roth IRA or a Roth 401k can grow tax-free over time, so you reduce that tax liability of non-qualified dividends. Qualified dividends would be more likely you could put it in a taxable brokerage account and or a Roth IRA so it grows tax-free, but non-qualified dividends, you want to get those tax breaks so you're not paying that high income tax on that money. Now, in order for a dividend to be a qualified dividend, it must meet a certain criteria. Number one is the dividends must be paid by a U.S. corporation. And number two, the shares must have been owned for more than 60 days. During the 121-day period that begins 60 days before the ex-dividend date. And the other thing to note is in a lot of situations, REITs will still be taxed at a much higher rate. So you got to think through this as you put together your investment strategy. Now, there are some cons to dividend investing as well that I want to cover before we dive into this. And the first one is that taxation. If you have those non-qualified dividends and it's being taxed the same rate as your earned income, that is not a great situation to be in. So those non-qualified dividends need to be in that Roth IRA. Number two is dividends are not always guaranteed, meaning that it's not a guaranteed income for your entire life. So you got to make sure that you hedge against some of this. So you got to make sure that you are actively investing all the time. Number three is, unlike things like index funds and ETFs, you have to go out and you have to find proper dividends and you have to select the dividend stocks that you want. So making sure that you understand this is a lot more work than passive investing would be is another con for a lot of people. And then number four is there are lower potential returns. Things like index funds in the S&P 500 have outperformed dividend investing over the long term for most dividend portfolios, so you just got to make sure that you understand those implications when you go into it. If you want to be a dividend investor, you want that cash flow coming in. You don't care about the long-term rate of return. Instead, what you care about is cash flow and covering your monthly income with that cash flow as long as your dividend is protected. Now, let's get into the steps you need to take to figure out how much you need to live off dividends forever. Step number one is you want to figure out what your annual living expenses are. So the way that you do this is you go back and look at your bank statements for the last 3 to 6 months, and you add up how much you're spending every single month. If you are okay with what your spending is right now and you want to spend that in retirement, then you can focus on this and have this goal in place so that you can replace that income with dividend income. Now, this will greatly vary from person to person. Some people who live in New York City are going to have a lot more money than somebody who lives in the middle of Alabama. So you got to make sure that you know your location, your preferences, and how much money you actually want. Another great way to do this is you can add up all the money you spent over the course of the last year, divide that number by 12, and that's how much you spent in the last year, and that's how much you need. So say, for example, you spent $120,000 last year, then you would need $10,000 a month in dividends in order to cover your living expenses. Number two is you need to figure out what your safe withdrawal rate is going to be. When you have this dividend portfolio in place, you need to figure out what you are comfortable with your safe withdrawal rate. One rate that a lot of people talk about is the 4% rule. We talk about this when we invest in index funds and ETFs because it's based on a study called the Trinity study. And the Trinity study showed that if you withdraw 4% of your portfolio every single year, this is the safe withdrawal rate to allow you to preserve your wealth over time. So if you want to replace it with dividends, you also have to figure out what your safe withdrawal rate is going to be. And it may just be replacing it with the amount of dividend income that you get each and every quarter, and you can add up how much that is over time. But making sure you have that safe withdrawal rate in the back of your head is another important step. Number three is to calculate the required investment amount. So what we want to figure out here is how much money do we actually need invested in these stocks in order to replace our income. So one key to do this here is you can put together something like a spreadsheet and start looking at some of the stocks that you're interested in. And the dollar amount that you have invested in those stocks is going to tell you how much you're going to make in dividends every single quarter. And this is going to give you a calculation that's going to allow you to figure out, hey, if my dividend portfolio is spitting out 3% in dividends every single year, that's going to tell me how much I need. Or if my dividend portfolio is spitting out 4% in dividends every single year, that's going to tell me how much I need to have invested. So say, for example, you want to live off $80,000 per year, and your dividend portfolio is spitting off a 4% dividend every single year. Then what you can do is you can go in there and figure out, hey, maybe I just want to withdraw my dividends and that's it. I want to leave my principal in there so it can continue to appreciate over time. So if you want to withdraw those dividends at that 4%, then what you do is figure out, I need $2 million invested in order to get that 4% in dividends. Now, this is going to vary from stock to stock. So you have to make sure that you are keeping notes and keeping a spreadsheet in place so you know how much you're making in dividends every single month so that you can replace that income. And then once you have the plan in place, you can choose dividend paying stocks. Now, my favorite way to choose dividend stocks is to look first at dividend aristocrats. And if you don't know what dividend aristocrats are, they are large companies that have been paying a dividend for 25 years or longer. You could think of companies like Johnson & Johnson, Procter & Gamble, Target. These are really solid companies that have been around for a very long time that have paid a dividend for a very long period of time. You want that dividend stock to have that long-term dividend growth over time. A great book on this is called The Single Best Investment by Lowell Miller. And this is my favorite dividend investing book. It absolutely changed the way I thought about dividend stocks. Where in that book, he talks about why you want dividend growth stocks and how it can really compound and turn into this massive dividend machine. Step 5 is to always reinvest your dividends as you are starting to build this wealth. Make sure your dividends are being reinvested because this is how your snowball begins to grow. And this is why the dividend investing strategy really works, because you have these dividends reinvesting and the snowball grows larger and then it spits off more dividends and grows larger and spits off more dividends over and over and over again. And then step 6 is to readjust and make sure you monitor your portfolio. With index funds and ETFs, we can just index fund and chill. With a dividend portfolio, you have to actively be monitoring your portfolio, making sure those dividends are growing, understanding that if a dividend gets cut in half, then you need to sell that company and move on to the next company. That is a sell indicator. So making sure that as you build wealth over time and as you have this dividend portfolio, you are monitoring that portfolio either every single quarter, every month, however you want to do it, and whatever makes you feel comfortable. But that is exactly the steps that you need to take in order to replace your income with dividend income. If you guys have any questions, make sure to leave them down in the comments below, and don't forget to like, subscribe, hit that notification bell, and we will see you on the next video.